Well, good morning once again, options traders. What's happening, everybody? And a question that I get a lot from traders is, why do you use spreads? And the argument that you hear against them is that they limit our potential rewards. And while that's true, it's really a limited way of understanding spreads and the math and the science of why we use spreads. So for those of you who know me and have done coaching calls, know that I'm always talking about spreads. They have to really be an integral part of your portfolio, and for very good reasons. Now, while there are a lot of different reasons for using spreads, and I could go on to a very long presentation about that, I want to highlight really two key reasons why spreads are definitely a little bit more than a bad strategy that limits profits. So as a quick review, remember what spreads are, and I do have other videos in this forum here talking about that if you're interested, but the basic idea is that you are going to buy one asset. And notice I said asset and not options. There are a lot of different spreads that we can use. So you're going to buy some type of a financial asset and you will sell another against it. Now this one that you're selling against it is usually the same underlying. It's going to tend to play off of the one that you bought. And by that I mean if one rises, the other falls. So for instance, a covered call is a type of spread. You're buying stock, you're selling a call. It's a spread. We have vertical spreads, we have calendar spreads, diagonal spreads. But again, it's not just limited to the options market. There's a TED spread, the Treasury Eurodollar spread. And there's even a notes over bonds spread. But in all cases, you are buying something and selling something else against it. But the big question that we want to answer is why use them? So while I said that there's a lot of different reasons I could go into, one of the biggest is that it creates a safety net. And what this means is that short-term adverse price movements can cause losses, as we all know. Anything can happen in the short run, no matter how good you think your insights can be. And so what it does, it gives added safety for the times when your outlooks are wrong. You have a wider number of conditions for profit. And I'm not just talking about adverse stock price movements or being wrong about the stock direction. There's a lot more risks to options than that. Could be something like volatility. There's a lot of different reasons why you could be wrong. It all depends on what your reason was for setting up the trade in the first place. But it's usually not just for one reason. So there's a lot of different reasons you could be wrong, but in the business we like to say that if you're wrong, you live to play another day. Spreads give you a much higher probability of that happening. So think about it for a moment. Take a look at the S&P 500 during coronavirus, start of March. Look at the cliff that we went off. Looked like the world was coming to an end. And yet up here, by about, let's call it August, we were right back to where we left off. So in a 5-month period, we completely recovered from this pit. So think about that. In stock market standards, 5 months is nothing. You haven't even gone through 2 quarters of earnings, and yet you were out of it, provided you lived to play another day. If you had everything sitting in here up at this point, and or else you were buying on the way down and just continued to take losses, you could be completely wiped out. Anything can happen in the short run, but by using spreads, it allows you multiple chances to be right. Now here's another thing to consider. Let's say that the stock rises from $100 to $120. If you bought the shares, that's a $20 gain. But what would have happened had you bought 4 100, 105 verticals? That's 4 $5 spreads. That's still a $20 gain. But if you think about it, there's a higher probability for the stock to rise to 105 than 120. So your spreads make maximum gain at 105, but if you're trying to make that 20-point gain with the stock, you need it to rise 20 points or 20%. Now, of course, yes, that's going to come out in the pricing of the verticals. Those profits will not necessarily be the same. But my point is that just because you have a limited $5 spread doesn't mean that that's all the money that you can make. You can put it on 2 or 4 or 10 or 20 or 100 times and multiply it out. Or better yet, you can give yourself multiple chances to be correct. So that's a really big benefit of using spreads. Now, the second big reason, and it's kind of related, but it has to do with risk management. And what it does, it allows your long-term outlooks to be correct. So, as I just mentioned, you can always face short-term bad luck. But if you learn to spread, you are spreading out that risk. It's a little bit different of an approach here. It's more of a diversification approach. So, as I've often talked about, a good analogy is with the casino. Casinos spread bets to survive. And a lot of times traders miss this. They don't realize that's really the big key to the casino. And they spread it among different games, diversify it there, and they also spread among different players. And this is what allows the casino's long-term edge to work. So for instance, let's take a look at roulette. And I've talked about this before in the fair value class, a really good example. But there's a lot of different bets you can take with roulette. But let's just concentrate on the single number bet. There's 38 spaces on the wheel, and you say, I don't know, I think number 15 is going to come up. You win 35 times your bet. That's what this means, 35 to 1. For every dollar you bet, you're getting 35 times that back. So that could be a risk to the casino. So even though the casino has a long-term edge of about 5.26% at roulette, they can face short-term bad luck. So for instance, let's say that somebody walks up to the table and bets $200,000. Or Bill Gates walks up and bets $1 billion. See, the casino could face short-term bad luck, and they're going to say, we just don't even want any part of that. And that's why casinos have what are called table limits. They're going to limit these massive bets that people might want to take. But let's say that they accept a $200,000 bet. If they lose, that's a $7 million loss. But watch what happens if two players walk up and bet $100,000 each. It's still the same $200,000. But now, assuming they're not betting on the same number, only one's going to win. So now it's a $3.5 million payoff. That's the 35 to 1 to the player who wins. But the casino also keeps the other $100,000 from the player who lost. So it's really a $3.4 million loss to the casino in that instance. But that's a whole lot better than $7 million, even though it was the same amount bet. The casino has sharply cut its risk by spreading off the bets. Now, what can happen in a perfect scenario is that the casino can get a perfect hedge. As I mentioned, there are 38 spaces on a roulette wheel. Let's say that 38 players come up and bet $100,000. Now that might look like a huge risk to the casino. There's $3.8 million sitting on the table. But only one can win. And so that means that $3.6 million goes back to the winner. That's the $3.5 million won plus the $100,000 that he bet. Remember, you don't lose your bet if you win. So they return that to you. But if the casino takes in $3.8 million and it pays out $3.6 million, that's a guaranteed $200,000 to the casino. So it looked like a really risky situation, right? $3.8 million sitting here was really a guaranteed deal. And if we look at the $200,000 guarantee to the casino divided by the $3.8 million bet, there's the 5.26 casino edge. So the main thing to take from this is to please don't take spreads as a beginner's strategy or one with training wheels. It's a way for the new traders to really limit their risk, but it's not what professional traders, want to aspire to. Those are all fallacies. The best traders in the world, just like the casinos, learn to hedge if they want long-term success. And that means they all learn to use spreads to survive. For anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and Strategy Lab at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.